Hello, my dear learners. Welcome back on the online channel. We are learning TYVMS Semester 5 Commodity and the Derivative Market. Today, in this video, we are going to learn the Chapter 5 Hedge. Before to start the lecture, hi, my name is Meenakshi Kandari and I am the expertise in the finance and accounts. Let's start the topic, the hedge. What is the hedge? A hedge is an investment that is made with the intentions of reducing the risk of adverse price movement in an asset. Normally, a hedge consists of the taking and offsetting or opposition position in the related securities. It means that the hedge always to be take care to or minimize their risk. Hedging is the risk management strategy employed to the offset losses in the investment by taking the opposite position on the related assets. So the hedging is the strategy that try to limit the risk in the financial assets. Popularly, the hedging techniques involve the taking the offsetting position in the derivative. Offsetting means what? To be balancing position or taking the opposite position in the derivatives that corresponding into the exiting position. Other types of the hedging can be constituted via the other means of the diversification. For example, you can invest the 70% in the equity and the rest of the 30% in the other more stable assets to create the balancing portfolio. It means that if you want to invest, do not 100% investment in the equity. Just invested 70% in the equity and the 30% in other benefit assets. So it is called the hedger or called the hedge in the market. Let's take the one more example of the hedge. When you buy the life insurance policy, you support and secures the family future in case your death or any serious injury in the some accident. So that time you have to buy against to be your death. So similarly, when you secure your A investment loss by the offsetting it with the B investment's profits, it is known as the hedging position. Now, let's move on the next part, that is the area of the hedging. There are the 5 types of the area hedging, that is to be a security market, commodity market, interest rate and weather and currency, etc. So let's in the detail the security market, the market where the buy and sold the securities like the share, like indices and other types of the equity. So that is called the equity or security market. The commodity market. In the commodity market, all the agricultural product, metal product, or we can say the hard and soft commodity are sold in this market. The third one is interest rate. This area including the borrowing and the lending of the rates and the risk associated with this interest rate in the term as the interest risk. Now the next one is weather. This might be seen the interesting that but hedging is the position and this area is as well. It's a weather. If you suppose we know that after in the rainy season the onion price will be high. So that time we minimize our risk and to be protect in the spot pricing. So that is called the hedge. And the currencies. What is the currencies? That here the areas comprises the foreign currency and the varieties of the currency which is associated with the currency market, that is the foreign exchange market. So here is the area of the hedging which is covered by the hedge funds. Now the next point is how to invest in hedge. The asset management company is generally employed the hedging strategy in the mitigated losses. The first one is assets allocation. This is done by the diversifications by the an investment portfolio with the various classes of the assets. For instance, you can be the invest 40% in the equity market and the rest of the 60% in the stable asset. So this is the balancing of your investment. The second point is structure. The structure is done by the a certain position of the your portfolio that is to be the instrument and the rest of in the derivative. So the one is the debt instrument and the second one is your derivative. So it is the debt equity ratios. The investing in the debt is provide the stability in the portfolio, while the investing in the derivative is give you the risk. So always to be your structures of the investment is debt and equity mix. Now the third point is the through the options. The strategy including in your option of call and the put option. This strategy and this is facilitating to secure your portfolio directly. So here are the three investor hedge. The first one, again I repeat, the asset allocation. You have to be diversify your asset between the equal ratio or the 40 and 60, 30 and 40 ratio. And the second one is your structure must be the debt and the equity ratios or any other derivative assets. Now the third is your option. Try to be always be an option in call and the put option so that your portfolio is directly suitable and secure. Now the student, let's move on the our next segment, that is the types of the hedging strategy. In the hedging, there are the three types, that is a forward contract, the future contract and the money market. So the hedging strategy are basically the classified in these three areas, that is a forward, future and the money market. So let's start the forward contract. It is the contract between the two parties for the buying and the selling on the specified date at the particular price. So this covers the contract such as to be the forwarding, the exchange contract and for the commodity and currencies. So the forward contract is a customized contract and it is to be generally for the over the counter market. Now the next one is the future contract. Is again it is the same, it is the contract between the two parties, but this contract is between the buyer and seller is the standard at the agreed price of the quantity and quality is already decided for the future date. So this cover the various contracts such as the currency future contract and last of the money market. So these are the market where the short term having the selling and buying in the short term period. So these are the types of hedging. Now the next move on the next segment, that is to be the advantages of the hedging. Now let's move on the next segment, that is the advantages and the disadvantages of the hedging. The first advantages of the hedging, it is the limit to the intention of reducing the risk. So always be hedger, try to minimize their risk to taking the offset position. Now the second one is the hedging, increasing the liquidity to facilitate the investor to be in the investment of the various assets classes. It means that due to the investment by the hedger in the different assets portfolio, so it is to be easily to liquidate their assets. Now the third point is the hedging is required to be the lower margin outlay. It means the lower margin expenditures and thereby it offers to be the flexible price mechanism. So here are the advantages of the hedging. So let's look out the disadvantages of the hedging. So the first disadvantage is to be the hedging involving the cost that can be eat up the profit. Of course, there is the cost is higher than the profit, because as the less profit, the less risk, high profit and high risk. The second one is risk and the reward are the often the proportionally to each other. Thus, the reducing the risk, there is a huge chances to the reducing in the profit. First of all, there is cost is so high. The second one is the less the risk, less the profit. Now the third disadvantage is to be to most short-term needs of the trader. For example, for the day traders or the hedging is the difficult strategy to follow the short-term the traders. Now the next disadvantage is if the market is performing well or the moving sidewise, then it is to be hedging others little benefits. It means that the hedging will be performed very not good when the market situation is well. So because they always be a try and to be predicate the minimize their risk. If the market is performing well, their outcome by the hedger it's very less or gaining the little benefit profit. And the last one is trading in the this option market, or we can say the future, often be the demand initiates the amount. So these are the disadvantages of the hedging. I hope you understand the meaning of the hedge, types of the hedging, area covered in the hedging, and the advantages and disadvantages of the hedgings. Thank you so much for the listening.